Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, central bank bonanza this week with both the ECB and the Fed. I think we were really sort of not expecting them to necessarily be super exciting meetings. You know, it felt like for both the kind of rate moves or not seemed pretty nailed on, particularly after the data this week, which we will, of course, talk about. But in the end, they were probably a little bit more eventful, or certainly in terms of market reaction, than we were expecting. So let's start with the Fed, Jan. Mixed bag, but I suppose, you know, in the end, leaned hawkishly. What was your take on that?
Yeah, it was a little bit of a frustrating meeting to kind of, if I had to pick a word, that's what I would go for, because like you pointed out, it's a mixed bag and it's really hard to take out a clear conclusion of what goes on in like the committee's collective mind. But I guess there isn't really like a collective mind because kind of the signals were all over the place. So in the first place, as expected and as they had communicated, the Fed did pause and did not hike at the June meeting, leaving the federal funds rate unchanged at 5 to 5.25. However, when we kind of got the release, we also got a lot of their economic projections. Since it's a quarterly meeting, they do it once a quarter, and we get to see their updated forecasts on not just macro variables but also on interest rates. What was surprising was to see for 2023. There were two more 25 basis point of hikes penciled in. So the median, what's called the median dot, the center point of all the forecasts within the Fed, it was raised to show another 50 basis points of expectations for this year. We thought we could have seen a 25, but 50 is certainly on the hawkish side of expectations. Not just that, 12 of the members were expecting 50, which is, really condensed at that center point as opposed to a big dispersion. We see dispersion in the next couple of years where some more officials expect cuts and others expect minimal amount of cuts. But for this year, it was very, very kind of, like I said, condensed and centralized around 50 basis points. A little bit shocking. Markets took that exactly in that way as soon as it was released, with a sharp sell-off in short-dated securities, short-dated fixed income securities. But nevertheless, it was hard to look at that and assume that they're thinking about this being the last hike at this given point. That being said, they did pause, and the press conference was a lot more neutral. Powell almost kind of what I called at the time a Freudian skip when he used the skip and had to correct himself into saying, oh, well, I shouldn't call it a skip. We're reevaluating. We want to see a little bit more data. Fair enough. We, in our view, that since they have paused now or skipped, we still think that July won't come with another hike. They're trying to see what the next payrolls, next CPI will show. Well, today we got some more data in the form of retail sales, industrial production, weekly unemployment claims, all of them kind of pointing towards more weakness in the economy. I'm going to quickly caveat this. The retail sales on the headline figure looks to be stronger than what was expected by markets, but that was largely due to caveats that aren't really going to transfer into the Fed's the GDP component of consumption, and also the Fed's personal consumption (PCE), the personal consumption expenditures indices. So Powell was neutral in his press conference, I thought, but on net, I think the goal was to just kind of persuade markets that they're not willing to cut this year, and they somehow achieved that. But longer dated securities rallied almost on like a policy error type of pricing.
What about inflation as well? We obviously had that this week. Now that was prior to the Fed meeting, so they will have seen it. We saw that. How did this week's print compare to your expectations, and what's I guess the key takeaway from this week's print, and how does that feed into your inflation outlook going forward? Because that obviously matters a lot for what the Fed are going to do.
Yeah, I think the inflation report had something for both bond bulls and bond bears. me being the bond bullish side. But let me start with the kind of like the opposition here, like the people who are willing to take it with more pessimism, I suppose. The truth is the headline number came exactly what was expected at 0.2 month on month, even though the year-on-year figure showed a big decline because of the drop of base effects. And just to clarify, last year about this time, we had a large ramp up in inflation. So as those are taken away from the yearly calculations, well, suddenly you see like a mechanical drop in the year-on-year figures. And similarly, core inflation was at 0.4. If you just look at it as it is, you can look back this year and be like, well, core is not really improving at all. We've kind of sidelining at 0.4 monthly, which is well above where the Fed wants to see. But if you kind of start digging into the report, and I know that you can't just start stripping out all sorts of components because eventually you get to 0% in inflation. But if you look at some core key measures that even Powell himself has measured, so core services X rents, that was supposedly, something that the Fed was paying attention to. Well, it came at 0.21, and it's been on a decelerating fashion because we all know that rents and shelter most shelter within CPI has a large lag. The Fed knows it. Everyone is aware of it. Endless amount of both physical and digital ink has been spilled on it. So we are going to see that coming down. It's just going to take a long period of time. If you use the BLS's new rents measure, you can already see new rents coming at close to 0%. So if we strip that out, 0.2% a month. Similarly, core goods increased by 0.4 month on month, but that was all because of the volatile used cars component. You take that out, you get flat core goods. And we already have some forward-looking indicators from alternative data providers that used car prices have been coming off, which will provide some tailwinds for CPI going forward. So I think there's a positive way to look at it. Maybe some listeners would call this a positive spin, but in my view, they're heading in the right direction. And core, both CPI and PC will fail to realize that what the Fed needs to see it to deliver those two more hikes until the end of the year.
Okay, you've kind of, I guess, in brief already answered my next question then, but perhaps you can give, I don't know, a little bit more detail around, what your rate outlook is from here. You clearly, you like you said, you've got this bond bullish bias as you have done for some time, but what's driving that? And I suppose where on the curve particularly are you more bullish than other parts?
Yeah, we still like the 3 and 5 year part, and I admit that it is very hard to just be long those outright, especially if you're funding them in overnight markets because of the negative carry and roll down, because of the shape of the curve. That being said, why we differ is we still think that is going to weaken from here onwards. The past has shown that the Fed's forward guidance has not really been a reliable indicator of where actually rates are going to go. It's more so a snapshot of what they think today. So we expect cuts to come much faster where the market is right now. So not so much. We don't really disagree with the next, call it like 3 to 4 months, but past that, we could actually see interest rates cuts coming, and more so into next year as well. So once you get these forwards repricing lower, you would also see duration coming down as well. So we're more pessimistic on the economy and more optimistic on the path of inflation than I should say what I hear from conversations or what we see in markets based on pricing as well. So still remain bullish, but we acknowledge that it's been a very rocky ride post SVB and the sell-off again. So I think we're kind of entering more of a buy dips mentality and less so like a high conviction bond fixed income is going to rally today type of stance.
Okay, that makes sense. All right, then, Giles, let's switch over to Europe because I did say it was a central bank bonanza. It wasn't just about the Fed. We obviously had the ECB today. We're literally recording this on Thursday afternoon, so I hope you've had time to digest your views. Like the Fed, a 25 basis point hike was very widely priced in. How did the ECB manage to surprise today then, if at all?
Yeah, that's right. So the ECB, it did its 25 basis point hike as absolutely universally expected. And so, you might have expected it to be a little bit of a boring one, but actually, there were a few interesting things. And above all, I think that what we saw was that they have clearly changed the way that they do their forecasting to make them structurally more hawkish, basically. And so, in a sense, they've done a little bit of a Fed here. They've found a way to really raise the bar substantially, I would say, to rate cuts. And I think that one of the, perhaps the key reason for them to do that is to try to see off the challenge from the market that they might have expected, that if you're done hiking, then we can move right on and start pricing in the cuts, which will happen next week or whenever. And so, what does that mean in practice? Well, I've got the projections here in front of me because I just wanted to make sure I got this right. But basically, they've reduced the GDP forecasts across the full horizon, not by a lot, but they have reduced them nonetheless, and they have increased the inflation forecasts. And so we have been highlighting that if you just take at face value the way that I guess the initial conditions, right? So what we know about rates, what we know about financial conditions, what we know about the path of inflation up until now compared to what was previously expected, you might possibly have seen a way for them to actually reduce their inflation forecasts. And in fact, we were actually highlighting the risk that they might actually forecast below target inflation at the end of 2025. So what they've actually done is, they've taken all that on board, and maybe they've done a sort of reparameterization of their models, or maybe they've just applied a little manual override. I'm not quite sure. It's a little bit opaque for all of us, but what they've got is an overshoot of inflation, not an undershoot at the end of 2025. And so that is 2.2% on core and 2.1% on headline. So I think with that, it means that it's going to be much harder for for any downside demand surprises to shock them towards doing less in rates. Basically, that is the bottom line. And so I think that the very, very clear message here is, don't expect us to be cutting rates this year. Probably don't expect us to be cutting rates for most of next year either. And so, the clear message here is higher for longer, which, to be fair, is what we thought we would get all along. But it's just interesting to see exactly how they chose to deliver that. I must say that against all of that, the delivery, the qualitative delivery in the press conference was a little bit more sort of dovish leaning. And again, I think that sort of links back to the whether it is conscious or not. I doubt it was conscious, but it's it mirrors the what the Fed appears to have done. And just one last thing I'd like to say: we heard for the very first time that I can ever remember a lot of discussion of productivity and unit labor costs from Lagarde in this. And of course, that's how you kind of square this lower growth, higher inflation. And so, it's quite a pessimistic view of the productivity of labor in the coming couple of years in Europe that they're communicating here.
Just wanted to pick up on one thing that you said there. You said, you talked about this idea that probably today's meeting, to the extent that anyone was expecting rate cuts at the end of this year or early next year, probably pushes those further into the future. So we're talking about this higher for longer rate regime. You said higher for longer, not high for longer. So I know that when we went into this meeting, we were thinking that this could perhaps be the last hike in this cycle. Has this reassessment of the way that they're thinking about inflation therefore changed the way that you think about how much higher rates could go, and how are you, moving a little bit shorter term, I suppose, than thinking about when rate cuts come? When do you think the peak comes? Is that already in, or is there ECB action still to come over the summer?
It looks very, very unlikely that the peak is in. I'm sorry to say. We were. I guess we're a little bit. Well, we have been more dovish for quite a while on the ECB path, if not on rates, the longer term rates. So, for a central bank that is in principle data dependent, it's a very sort of weak data dependency in a way. I mean, what it seems the message is we're data dependent in the sense that if the data turns out to be really, really bad, we won't hike again. But if if it's not, then we will. I mean,
it's a bit of an asymmetry.
Yeah, it was. If they, we would have to have a material something that materially pushes us away from our expected path for us not to be raising rates in July. That basically means we've got 6 weeks for financial crisis or something like that to derail this. We are very, very likely getting a rate hike in July. Okay, so I think that's...
Heard it here first. No financial crisis in the next 6 weeks.
Well, 6 weeks is not that long a time, but I mean, of course, these things creep up on us and then they bounce, don't they? But I don't want to suggest to anyone that I'm expecting a financial crisis. I'm just saying that that's the sort of thing that might change that might change the outlook from them. So I guess that the bottom line here is that we are now looking at maybe a pause at 375. I thought it was interesting there wasn't the emphasis on future decisions, plural. So they're really only guiding us strongly on the next meeting in July. They're not really telling us anything about their any prejudgment or anything like that for September. But I guess you have to accept that the likelihood at this point of another rate rise to 4% does look higher than the likelihood that they don't raise rates again now. Okay, so it's 375, but with upside risks. But that, I guess, is now solid market expectation as well.
Okay, let's just bring that back to the market then. How does that leave your market views? I know that you've been bearish bunds, obviously, for a long time. We've sort of tempered that bearishness slightly over the last couple of weeks. Is that back on now? You think 10-year bunds can go higher than 3%?
I'd say that 3% is still a reasonable target. We're 50 basis points, roughly speaking, away from that now. I don't see why you shouldn't be reasonably confident talking about 3% rates if you think that policy rates are going to be 3.75% or 4% and they're going to stay there for a year or so. So I think that that's consistent with this higher for longer sort of narrative. I think that we've seen, I think, a little bit of positioning sort of overhang and trouble with supply over the last couple of weeks, really, and that could, of course, have been also linked to the central banks and CPI and lots of all this event risk that just meant that people were a little bit more nervous about warehousing things. But also surveys have shown, frankly, particularly in the US, because we don't have any good surveys in Europe, that investors seem to have been, or at least on some of those, the widely followed ones, there seems to have been a bit of a long base out there. And so I think that all more or less points in the same kind of direction. But above all, I just think, as it has been for a long time, I think that anyone who is sort of sitting long and with an inverted yield curve, bleeding carry, is going to find it frustrating, particularly over the summer and also over the longer haul as this background grind of QT and supply and so on, so it just kind of chips away at this. It's going to be frustrating to wait for the turn, which could be quite a long way away. At the same time, I think that we are going through a bit of a risk-on sort of moment, and stocks seem to be reasonably unconcerned about higher policy rates or moderately higher policy rates in the short term. I think that anyone thinking about how to protect their gains in stock markets are probably calculating that that being longer rates is not a great way to do that, particularly if a lot of your gains are in things like US tech and so on. So yeah, absolutely, still bearish on rates, still looking, broadly speaking, for curve steepness, particularly 10s, 30s, but also shorter on the curve. Asset swaps, I think at these sorts of higher rate levels, you're expecting those to continue to tighten. And the long Italy that we spoke about a couple of times in recent podcasts has been doing fantastically. A little bit less well in the last couple of sessions. I recognize that, but broadly speaking, I stick to my guns when I say that you're meant to be long Italy unless you've got a really good reason not to be. And of course, valuations can be a pretty good reason not to be. And not on many metrics, which I won't go through now, Italy looks pretty expensive, but it doesn't look so out of line that I think that you would necessarily want to be short. I think you'd be sort of equal weight or long Italy still. But anyway, that's enough from me. Let's round off with you and the UK, Imogen. So I guess the big thing this week was the labour market, which you already sort of teed us up for in last week's podcast, and that was surprising, to say the least, and drove a pretty dramatic correction or repricing in the front end. So I think everybody would be very keen to hear how you feel about that.
Yeah, I mean, just like every piece of UK data, it feels like at the moment, the labour market data also surprised to the upside. I think we spoke last week about how, away from just the headlines average weekly earnings number, we'd be looking at the detail within the kind of employment data. That was what really surprised to the downside last month. And, really on all of those counts, it was a beat versus expectations. There was a significant revision up to the drop in employment numbers last month. The labour force survey measure, which last month showed a shift towards part-time rather than full-time employment, looked much more balanced. And then, of course, we had this big beat on the average weekly earnings number itself. So a kind of perfect storm, I suppose, of upside surprises, which led, like you say, to a big repricing, both in terms of bank rate expectations but also the front end of the yield curve. Obviously, the two very closely connected. When it comes to the revisions to bank rate expectations, I actually wouldn't push that much against how markets are pricing for June, i.e. next week's meeting, and we can go on to talk about what we're expecting for that. But what we really saw was just a reassessment of how high terminal rate will have to get to, rather than how quickly the bank will get there, i.e. the market didn't price in a dramatically higher likelihood of the banks hiking 50 basis points next week, which I actually think is right. I think actually probably 20% chance of 50 basis points, as the market has priced in right now, probably looks quite fair. I mean, we ran through the list of reasons last week why we didn't think 50 basis points was likely. That was ahead of the upside surprise in the labour market data. But I still think a lot of those reasons are valid, to do with not wanting to look panicked, not wanting to look like they've been wrong with the amount of tightening that they've delivered so far. And also just, mathematically, the difficulties with actually getting a majority of votes from the committee for 50 basis points. And to the extent that you'd be looking for the more hawkish members to vote for 50, so Mann and perhaps even Haskell, they both sort of spoke or commented this week, and neither sort of explicitly put 50 basis points on the table or were as hawkish as I think you might have thought they could have been against this backdrop of kind of upside surprises in the data. Both of them spoke or commented before the labour market data, to be fair, but obviously they both of their comments came after the big upside surprise in core inflation last month. So if they wanted to have been more hawkish I think they could have been. So for me, it still feels difficult to get 50, and I think the market is on board with that view as well. I think expectations for bank rates are now starting to look a little bit stretched, not necessarily in terms of level. I don't rule out that there could be hikes beyond 5, which is our base case scenario, up to 5.5. What I would probably push back more against is this idea that they will still be hiking, well into next year. I think the market's now pricing the peak in February, which feels late. So the terminal rate that the market's pricing now feels a bit high and a bit late. But overall, I think pricing for next week seems fair, in line with our expectation that a 25 basis point rate hike is the most likely outcome, but we can't definitively rule out 50, I suppose.
Okay, pretty comprehensive on the Bank of England. But is there anything else that we should be watching for other than just the rate decision?
So it's not one of the quarterly meetings. It seems like this week the ECB and the Fed used their forecasts as a way of kind of recalibrating their reaction function, if you like. The bank won't really have that opportunity to do, because it's not one of their monetary policy report MPR meetings. It is just a bank rate decision where we'll get the vote, the minutes with the guidance, and that's it. So the only, I guess, other cues that the market can take from is the vote itself. Like I say, we think that the support for 50 is going to be pretty limited. So we actually, in our base case scenario, only have Catherine Mann, the most hawkish member, voting for 50. And probably the two doves, Tenrera and Dhingra, continuing to vote for unchanged rates. Dhingra also spoke this week. The MPC have been quiet for about 3 weeks, and then suddenly they're all talking on top of each other this week with a sort of contradictory points in some instances. But Dhingra also spoke this week, and she was talking about how, as she has been for a long time, the lag transmission mechanism of monetary policy, the fact that it is working, it's just taking longer to feed through than they thought. So I imagine she will continue to vote for unchanged rates, as will Tenrero. And this is, of course, Tenrero's last meeting. So 162 is the vote we're looking for. And then on the guidance, we're expecting that to be unchanged. They keep this kind of asymmetric skew of risks, I suppose, like you were talking about with the ECB, where they just talk about, if they continue to see further persistent inflationary pressures, they will act accordingly, i.e. it's not balanced, that they might act in either direction, but they're data dependent, and they will be acting on with further rate hikes if they need to. So all in, perhaps famous last words, but I think we're pretty much in line with consensus, and I don't think that this should be a particularly exciting meeting. But it feels to me like, given what the market is pricing in, some small chance of 50 basis points, and then a significantly higher terminal rate than here, and especially after, perhaps more hawkish Fed and ECB meetings this week, it feels difficult, or it feels like it's going to be difficult to me for the bank to out-hawk market pricing at these levels.
All right. Well, I guess that just leads me to ask, okay, I know that you were working through your sort of Bank of England playbook and so on, so you maybe got some thoughts about the skew of risks with the meeting itself, but more broadly, what just summarize your market views for us again.
Yeah, so we've obviously had this big sell-off in gilts. Front end has been leading the way of late, and that's certainly what's been, I guess, grabbing the headlines, with 2-year gilt yields now back up to or beyond those post mini budget highs. I think that they're starting to look stretched, but I worry that there's no catalyst in the near term for them to really reprice significantly lower. No one's going to kind of take the other side of that meaningfully ahead of CPI and the Bank of England next week. And even over the summer, I don't think we get a real reassessment of, the market's view of terminal rate, probably until the August meeting, where we get these quarterly forecasts from the Bank of England. So, and to the extent that, gilts continue cheapening to beyond these kind of mini budget highs, conversely to what you would normally expect, with the cheaper that they get, the more demand that might bring in. I think it's actually having this sort of adverse effect in the UK, that the closer that we get, or the further beyond we go from those mini budget highs, the more worried the market becomes about, how unsustainable these kind of moves are. Now, clearly this is very different to last year. We've been through that before on the pod. It wasn't all just about the level of rates that we got to last year, but the speed of the move. And, in the days following the mini budget, we moved like more than 100 basis points in 2-year yields. This week, we've moved 20 basis points. So I think it's important to contextualize the size of the moves that we're seeing. And also, we're starting from a much higher base. Bank rate now is significantly higher than it was back in September and October. And we have expectations that it will go higher still. So this time definitely is different. But even against that backdrop, I think that front-end yields are starting to look stretched. But I worry that, like I say, there's no kind of real catalyst in the near term to trigger repricing. For longer dated yields, I think that this supply demand imbalance story continues. I don't need to harp on about it on this pod anymore, but everything that you were saying, Giles, to the extent that you were long and you're now paying the carry on these flat curves, you're waiting for that kind of pivot point from central banks, or the pivot point in inflation, to look to get long duration again. Clearly, that point just keeps getting pushed further and further into the future. And I think that continues to weigh. It's a relatively short supply week for the next couple of weeks in the UK, but then duration becomes pretty heavy again in July. We have a lot of long end supply, and we have the linker syndication. And next week, we'll also have the QT calendar published for the next quarter, where the pace is going to have to pick up slightly for the Bank of England to meet its planned run rate of shrinking the balance sheet by 80 billion by September. They're slightly behind that, sort of naturally, given that they ended up starting late, but they kept the same yearly target. But we are going to see slightly more active sales, I think, next quarter from the Bank of England, which just adds pressure, given that they're selling more at bigger losses, and like we've been through before, that just gets absorbed into the public finance equation. So happy to remain bearish. We still have this 4.6% target in 10-year, which obviously doesn't feel super far away now, but I think given this environment, you could well see it, easily see an overshoot of that level before coming back down towards fair value. Okay, that's probably enough from me. Let's catch up next week, when we will actually know what the Bank of England have done, and see if they can deliver any surprises like the Fed and the ECB. Thank you both for joining me, and thank you to our listeners for listening in. Just a reminder that if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.